Hi, it's John Kelly. In this module, we are going to discuss journal entry testing as required by 240.32a. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. And as this requirement is a procedural requirement, not a risk-based requirement, it is particularly important that we document that we have done the required procedures. Now, this section is based on academic research that found that people who commit fraud also make journal entries. And the conclusion was it would therefore be a good idea to test journal entries to find fraud. Now, this is a little bit like doing research and finding out that bank robbers often wear shoes, and then using that research to tell bank tellers that if they want to identify bank robbers from among people walking in the bank, that the way they should do that is see whether or not they're wearing shoes. And of course, that doesn't help identify bank robbers. And that's because the relationship between wearing shoes and being a bank robber is coincidental and not causal, just the same way that the relationship between fraud and a journal entry is coincidental, not causal. And this is the first of at least 3 logical fallacies that are inherent in this section, and that is that journal entries don't cause fraud. And unfortunately, what the standard setters have done is they've set up a bit of an expectation gap, because they've told financial statement users that auditors are now testing journal entries, and that because of that, this is going to somehow or other increase the chances that auditors will find fraud. And of course it won't, at least in any significant way. And that's because increasing the odds of finding something from 1 in a million to 2 in a million can be advertised as doubling the chances of finding something, but a statistician will tell you that that changes the odds of finding something from insignificant to insignificant. So there's an increased cost, but no particular benefit. And this is one of the many Sarbanes-Oxley changes to auditing standards that have increased significantly the cost of doing an audit, and I guess auditors shouldn't complain about that. The other thing we need to think about in this is the odds of finding error and fraud. And we need to remember that auditing standards tell us that there are inherent limitations of an audit, and that even a well-done audit has the possibility that the auditor may not find errors. So if there is subsequently an error found, the auditor would say, well, no, I followed standards, I did a good audit, I have documentation that proves that, so I didn't fail in my audit, I did a good audit, and you just need to understand that a well-done audit might occasionally miss an error. Standards go on to tell us that with respect to fraud, we're even less likely to find fraud than error. We're more likely to miss fraud than error. And if it's management fraud, standards tell us that that is very, very difficult to find. If there's management fraud, it's very difficult to find. The other thing that standards tell us is that we can accept records and documents as genuine. And journal entries are part of records and documents, so standards tell us that we can accept them as genuine, unless there's some reason for us not to believe it. So there would have to be some reason or characteristic that would cause us to believe the journal entry wasn't appropriate. Otherwise, we're allowed to accept it. The other thing standards tell us is there are 3 main reasons that we may miss fraud in an audit, inherent limitations of an audit for finding fraud. And they are sophisticated concealment, collusion, more than one person getting involved trying to cover it up, and the fact that it's management fraud, which is much harder to find. Now, are all those 3 likely in journal entries? And particularly when the stated purpose of this section is to help us find management fraud in journal entries? Well, the rest of the section tells us that if it's management fraud in journal entries, the odds of us finding it are very, very low. And so it makes it very unlikely that we're going to find fraud in journal entries if it's perpetrated by management, concealed with collusion. So what are the solutions? We're probably going to miss it, and then people will be disappointed and say, hey, you were supposed to test journal entries and find fraud, and you did test them, but you didn't find the fraud. Well, what are our solutions? And documentation is going to be very important. The first thing we are supposed to do to help us find fraud is to be skeptical, so we should be, and we should be sure that in our audit documentation we have documented that we are skeptical. And in the documentation module, I talk a little bit more about how we might document that we were skeptical. The other thing that we must do is, this is a procedural standard, so we should be very sure that we have documented, we have done what is required by the standard. The procedures required, we did them, and we'd better document that. So what are the requirements in 240? Well, there are three. We are to inquire of management about inappropriate activity around journal entries. So our documentation presumably then be, we should have a checklist step that says, remember to do that, and we would inquire. And then presumably in the representation letter, we will document the response to that inquiry, where management tells us that they are not aware of any inappropriate activity around journal entries, and that documentation implicitly documents that we inquired. We are required to select some year-end journal entries, and so again we need a checklist step to remind us of that, but we should remember that we've probably already done that. When we're testing property, plant, and equipment, we have tested the year-end entry that recorded depreciation, so we tested that year-end journal entry. When we tested accounts receivable, we tested allowance for doubtful accounts, and that was recorded at year-end by a journal entry. So we've already tested some journal entries. So we need to stop at that point and say, well, we've probably already tested a bunch of year-end journal entries, and have we tested enough? So if we have, we've now satisfied that requirement. Third requirement is to consider testing other journal entries made at other times in the year. And so our documentation of that should be that we should consider that, and then we should conclude whether or not, based on our understanding of the client, that we need to test more or not. And so we would either decide to test more or decide not to test more and document that. And there's kind of a fourth requirement in 315.18F, which is that the auditor shall obtain, so there's the shall word, we have to, relevant information about internal control, including controls around journal entries and including controls around making non-standard journal entries. Now, because of the expectation gap that standard setters have created for us, documentation is really important. So we need to make sure that those three procedural requirements of standards have been done, and perhaps we include the fourth one in there. So that documentation is critical, and we need to have that documentation in our file so that we can defend that we did our audit in accordance with professional standards, even if subsequently fraud is found. Now, there are some other hints where standard setters try to help us in 240A43, and the first one is to help us identify fraud is whether we have already identified fraud. So, of course, that's going to help us because we already know there's fraud. But again, testing the change and not the journal entry is going to be what's important. We suspect that accounts receivable is way too high, and that's what we're going to test and get evidence about, looking at the journal entry that approved the big change in accounts receivable really doesn't help us much. So if we've already identified a fraud risk, we should already have documented that and already have specified testing, and it doesn't really help us with testing journal entries. Second hint is to consider internal control, which kind of goes back to that requirement in 315. It tells us that we might test it. Probably not a bad idea. So we would probably have a checklist step to remind ourselves that we need to think about internal control over journal entries, and we might perhaps note who makes the entries or document the controls. And in a smaller audit, for instance, we might find that there's only one or maybe two people that make journal entries. The bookkeeper perhaps normally makes journal entries, and non-routine entries are made by the chief financial officer. And that might be all there is to the system of internal control. We might document that. That'd be not a bad idea. In a larger audit, a multinational audit, it's probably true that there is a system of internal controls that surrounds the making of journal entries. So we might want to document that and understand that more. In that system, a non-routine, an entry not made through the normal system, might be a little more obvious, and we might want to look at those perhaps. Third piece of advice is that journal entries may be manual or by computer. And I don't know how that helps us find fraudulent ones because, of course, it's either going to be manual or computerized. Now, the fourth set of helpful hints are characteristics of fraudulent journal entries. And unfortunately, this is not much help because while these items that are described in this section could be indicative of fraudulent entries, they also could be indicative of a normal entry. Probably most of them are more likely to be normal than to be fraudulent. So made to unrelated, unusual, or seldom used accounts, well, that could be fraud, but the monthly journal entry for depreciation is going to go to a seldom used account depreciation expense, only used 12 times a year. Unrelated or unusual, well, if we accidentally posted a fixed asset purchase to cost of goods sold, and we have to make a journal entry to put it back into fixed assets, we're going to be crediting cost of sales and debiting fixed assets, and that's a bit of an unusual entry. But we should expect that of many journal entries, that they're unusual because we're fixing a mistake. So could be fraud, far more likely that it's a normal entry. Made by individuals who typically do not make journal entries, well, that will depend a bit on our understanding of the system. But if the controller typically does not make journal entries because the bookkeeper does, but it's normal that the controller makes journal entries, that's probably not fraud. It's probably just that the controller occasionally makes entries to correct mistakes that the bookkeeper has made, for instance. Recorded at the end of the period or as post-closing entries that have little or no explanation or description could be, but also the pressure of doing month-end or quarter-end or year-end may mean that we don't write down quite as much about the journal entry as we should, so that could be entirely normal. It could also be fraud. Doesn't help. Made either before or during the preparation of financial statements that do not have account numbers. Not quite sure what the standard setters meant by financial statements that do not have account numbers, because financial statements would not normally have account numbers. I suspect they meant journal entries made to accounts that do not have account numbers, or made without account numbers, though if that's what they'd meant, presumably they would have said it. But could be fraud, could be normal. And containing round numbers or consistent ending numbers could be, but again, the monthly depreciation entry is probably $30,000 a month. And it's the same number every month, or $30,333.33 a month. So could be fraud, could also be a normal entry. So that's not much help. And this is our second logical fallacy. We'll refine our bank robber research to find that it's not that bank robbers just wear shoes, they sometimes wear brown shoes. So suspect everybody wearing brown shoes of being a bank robber. Well, even if all fraudulent entries contained rounding and ending numbers, not all entries containing round ending numbers are fraudulent. So it really doesn't help us much to distinguish fraudulent entries. And that's the fallacy of cum hoc ergo propter hoc. So that advice is either of no help, it won't identify fraudulent entries, or it's dangerous, because if you pick an entry that has a round ending number and don't recognize it as fraudulent, now you're in real trouble because you've documented something as not fraudulent when in fact it was. So it doesn't really help the auditor much. Our best response, I guess, then, is to ignore this advice because it could get us into trouble and concentrate back on 240.32a, the three procedures that we must do, and making sure that we've done those three procedures. Now, perhaps better advice would be to look at what are sometimes called topside entries, large adjustments that are made at year end to change the general ledger to get to the financial statements. And if you look at C and D and interpret it that way, large adjustments made when preparing the financial statements, then that's much better advice. And so, for instance, if at year end, the general ledger and the accounts receivable subledger say that accounts receivable is $100,000, and management prepares a journal entry that increases receivables by $2 million to $2,100,000, we might well be interested in that change and might well be interested in finding support for why this enormous increase has occurred in accounts receivable. Now, I really don't care that it was a journal entry. I care about the great big change and why there is support for such a great big change. So topside entries, big changes made at year end, that I'm interested in. The next set of advice is about the nature and complexity of the account. So transactions or journal entries made to accounts that contain transactions that are complex or unusual in nature could be fraud, but also could be normal. Contain significant estimates and period-end adjustments could be fraud, could also be entirely normal. Have been prone to misstatements in the past could be fraud, could be normal. Have been unreconciled could be either. Contain intercompany transactions. This one, sure, that could be fraud, but it's far more likely that it's not. The intercompany transaction account, that would be normal transactions between two companies, and are otherwise associated with an identified risk of material misstatement due to fraud. Well, that's no help at all. By definition, if we already know that there's fraud, that really doesn't help us identify fraud. Now, what that advice really is a list of risk of material misstatement factors of either error or fraud. I would be probably more concerned about error in each of those circumstances than I would be about fraud. Or I guess maybe I should say I'd just be concerned about misstatement. I don't care whether it's error or fraud. I care about identifying the misstatement. So we should be considering those regardless, and it really has very little, if anything, to do with journal entries. So that's the third fallacy. Sometimes bank robbers wear brown shoes, and you should have known that that person was a robber because they wore brown shoes. Post hoc ergo propter hoc. So if later a journal entry is found to have one of those characteristics, it's unfair to suggest that the auditor should have known it because those characteristics could have been fraud or could have been ordinary. So that's the third fallacy. Sixth piece of advice is if the journal entry is outside the normal course of business. Well, of course, and 315 tells us that anything that's outside the normal course of business is a factor that one should consider when thinking of risk of material misstatement. So not a bad idea to prompt in a checklist to think about things that we see that are outside the normal course of business. But again, that has nothing to do with a journal entry. That has to do with being outside the normal course of business. So what should we do? Well, we clearly should consider large year-end changes. I don't care whether they're made by a journal entry or not. Any large year-end change made in preparing the financial statements or the consolidated financial statements, topside entries, that's something the auditor should be interested in. And we should consider whether or not we've already audited that, and we may well have. And if we've already audited it, and we've looked at all the big year-end changes, then we're done with testing journal entries. And of course, as I said at the beginning, documentation that we have performed the required procedures is extraordinarily important. We're probably going to miss the fraud, so we need to document that we performed the required procedures, and we can then demonstrate that our audit was done in accordance with professional standards, because our audit should be judged by the documentation that we did it in accordance with professional standards, not by whether subsequently a fraud is found. And don't randomly select a sample of 50 items for a month from throughout the year and then test whether or not they've been approved. This is something that I've been told was initially suggested by inspectors and standard setters as a way of dealing with this. It obviously is an ineffective way of doing it. It produces pretty documentation. You can document that you did something, but it really misses the point of the section. So don't do that. You're going to confuse staff. You're going to confuse yourself. So, thanks for listening.